Hello, I'm pleased to welcome today David Buyck, Head of Advisory at Buyck Family Advisory Office. Welcome.
Merci, bonsoir.
David, just maybe a short introduction, who you are and what you are doing in this role of advisory for family offices.
Well, today I've now 3 years back in the family office, and historically I've explored the financial trade. Maybe close to the topic today, I wrote my thesis on liquidity in FTP rates in banks, and still have this exposure to corporates, but also to the financing activity of family offices.
Okay, so we will talk about treasury for corporates, but okay, you're also familiar to what corporates could face as treasury issues.
Absolutely, and understanding that from a balance sheet perspective, ultimately whether you're a big corporate or your family with different operating businesses, one sometimes melts into the other.
Okay, very good. So let's start maybe with the first question. So how can treasury professionals demonstrate the strategic and monetary value of sustainable investment to the C-suite?
Well, actually what's interesting is that historically treasurers have been sitting between two sides of the balance sheet. And ultimately they have been looking at liquidity transformation, maturity transformation, and size transformation. And this is a view where they were subjected to changes in the business operations, in the supply chains. And I think what's interesting today is that a different view is emerging. And that view is one where you have to look at your business not in isolation, but holistically. And a treasurer can play a much stronger role because he sits at a confluence of information within the firm.
Okay, super. And so how does the corporate treasury role ensure investments are aligned with this real business needs?
Well, it is the chance of a treasurer to have been exposed to adjustments in spreads according to the type of risks, and in the past decade, I would say, environmental sustainability risks has been translated in basis point adjustments, and so the treasurer has an experience of negotiating terms with financiers, and I think this is the experience they can leverage today to look at the operating business, the cash flow generating units of the firm, look at the risks which are exposed there, and drive that home to the management. Going back to your first question, bring the monetary value to stability, because in the end that translates in a lower price, stability of cash flows due to lower risk, operational risks that are taken at the level of the firm.
Maybe a side question to remain on that topic. But don't you think that usually corporates are mainly driven by the price? So if you have a sustainable investment or let's say borrowing, maybe the price could be improved because of the quality and the type of investment. But I have the impression that sometimes because of the constraint of being ESG compliant, the benefit is not, let's say, enough to justify the effort on the other side. And so we have the impression that in our community, a lot of corporate treasurers are a bit disincentivized because the gain is not justifying the admin burden created to be ESG compliant.
And I think that's a very fair point that you're making. I think historically, and until perhaps even as late as last year, there was a very relevant view that regulation was a driver to make those decisions. However, what a lot of corporates are seeing today is that, and what I mean a lot, is that we see a critical mass of, according to the country, between 10 to 15% of the corporates are realizing that the resilience of the supply chain they operate in has a long-term impact on the viability of their cash flows, and the volatility of their cash flows being reduced then in turn translates in more favorable financing terms. So indeed, to your point being, you see corporates chasing perhaps historically the basis point in negotiation with banks, but if you take the longer term view, which is, I admit, sometimes more difficult, if you take the longer term, for treasurers, you have to look through the business cycle. If you look through the business cycle, it is definitely advantageous. And so that is one view, one element. And the second I would share with you is that we are seeing for, and then I take the view of family-owned businesses, people looking beyond the business cycle. They say that, for instance, energy costs can definitely be something that they can digest at a higher cost base if there is predictability. So what is key here is the fact that if they have predictability of input costs, they can have a sharper or more consistent pricing, and therefore a more stable conversion process of customers or a better retention of customers. So ultimately, it is indeed true that you may be driven by short-term objectives to negotiate, better terms on, commercial paper issuer or rollover credit. However, if you can take the long-term view, you can distill.
Yeah, if you have predictability and resilience in view, and again, problem with CFOs and treasurers, they usually think in terms of quarters or next quarter or the maximum 12-month rolling forecast. So it's a bit difficult to project yourself in the long term and say, okay, I see the value of being resilient in terms of supply chain or in terms of financing. Yeah. But maybe another question, how can treasurer help their firm navigate investment opportunities and de-risk operational activities? So we come to the point we just touched.
Yeah, I think here it's the quantitative element, the experience of the treasurer that can be brought to the C-level, that can support the CFO or C-level decision makers, because they can show their forecasting abilities in each of the decisions being taken. So if the firm is embarking on venture strategy, which is causing them to be exposed to startups, they become their clients, so they do venture clienting, all of a sudden they can de-risk certain activities. De-risking can perhaps mean that you can have a greater projection of needs of working capital, meaning that you can improve your cash conversion cycle, means that in turn you have a cheaper weighted average cost of capital. So it is the financial element which needs to be not dissociated but fully integrated in those decisions, and I think this expertise lies with the treasurers.
It could be virtuous, yeah. And maybe a final question. So, what could be the pieces of advice or the tips for corporate treasurers? Because we explained, so maybe too short view on the future, too let's say concentrated in terms of financing, bank borrowings usually in Europe. Not enough capital market or other way of financing. So what could be your view? I know that you were recently at the Davos forum, so any tips or piece of advice you can give to our corporate treasurers?
Yes, I think there is something that stuck with me very strongly, and that is that we have to stop to be anthropocentric, but to be ecocentric. So you have to look at the ecosystem in which you operate. And to take your example of chasing the cheapest funding source, ultimately it is the treasurer which can support these key management decisions, because sometimes C-suite or a board can be precluded from making investment decisions, taking venture, simply by the fact that venture is a more long-term game that you need to play, where effects are crystallizing over 7 to 10 year horizons. And historically, this is not the type of funding which a corporate was trying to attract. However, today you see coalitions being built. I think you talked about Davos. We see a lot of people centric coming back to Europe, saying, okay, how can we build European resilience? And ultimately you see interest.
And competitiveness.
Competitiveness, absolutely. And you see interest of saying, okay, which other forms of private financing can we bring to the corporates to pursue those strategies relevant for their resilience? And sometimes it doesn't flow through typically the balance sheet, and that comes back to the previous point you raised, is saying, well, if you have to invest in a business for 7 years, well, the first part of the J curve you are accumulating, if you have to consolidate this firm, negative figures. Absolutely. So you're in the red, not in the black, and unfortunately that doesn't sound very appealing for an investor which is looking at the financials on a quarterly basis.
But it could be part of your strategy, and so it's a question of diversification. We keep thinking that diversification of source of funding is not something that we corporate are, let's say, implementing, again, because we are, let's say, considering the price as the first priority, and the second, we are just a short-term viewer. So what is and I like the idea of bringing together the operation and treasury, where we could generate some added value to the operation, although treasury is very often perceived as completely pure finance and completely separated from me. Do you agree with that?
Fully agree. I always, when I was talking about the thesis I was writing, I was always saying that, the treasurer sits at the helm. He sits at the top. He has the macro view. Even if it's the C-level which makes the decision, the treasurer has that macro view, and money and numbers don't lie. So
Okay, but thanks a lot for this insightful comment and response and answer to my questions. So thanks a lot, and I hope that you enjoy this exchange with David.
Absolutely. Thank you for having me.